All right, okay. I've switched my text to organizer and panelist.
Welcome back. Once again, here are your housekeeping reminders. The digital guide is the home of your summit experience. Please remember to come back to the digital event guide after each session to navigate the next one. All sessions will start exactly at the appointed time. Through each session, you will have the opportunity to ask questions of the speakers. To ask your questions, please enter your question in the Questions tab or in the chat interface. Select the drop-down and select the option Send Question to Staff at the bottom. Your host will moderate the questions. Please do remember to navigate the event guide and visit all the tabs in there. There is a special prize for the winners of the game. Do also visit the virtual exhibit booths of our Platinum sponsor Refinitiv and our other sponsors, without whose support this summit would not have been possible. We would also like to express our gratitude to our association partners, our growth partners, our academic partners, and our outreach partners. Lastly, webinar fatigue is a real thing. In order to make the best of each session, please remember to take a break, stand up, walk a bit, stretch a little at the end of each session. It is my pleasure to introduce Anindya Banerjee, CMT volunteer leader engaging with corporations. Anindya began his career 16 years ago in commodities. Since the past 10 years, he has been heading research in foreign exchange and interest rates for Kotak Securities. He considers technical analysis and fundamental analysis as two important tools to analyze any trading market. Hence, his approach has always been a blend of both. He is also widely quoted in newswires and electronic media. He is a yoga and a music enthusiast. Over to you, Anand.
Namaskar and a very good afternoon. There are decades where nothing happens, and then there are weeks where decades happen. Ladies and gentlemen, 2020 is one such year, and it's not over yet. A truly global pandemic is sweeping across the world. In its wake, it has left over 1 million dead and many millions infected. The scale of pain and suffering is immense. From governments to business to households, none have been spared. Financial markets have witnessed enormous volatility, but thanks to the proactive measures of the central banks, things have calmed down, at least for the moment. But we also know periods of maximum chaos are also periods of biggest opportunities. To guide us through this chaos and show us those opportunities, we have an esteemed panel of experts. It gives me immense pleasure to welcome the panelists. First, Mr. Sunil Beri, a veteran in the financial markets. He has diverse experience spanning from fixed income, currency, and commodity. He has worked with world-renowned banks. He was in the treasury of Reliance Industries, and he very recently was the editor of Real Vision. Next, we have Mr. Vaibhav Sanghavi from Avendus Capital. He's the co-CEO as well as the lead portfolio manager of their AIF funds. Mr. Sanghavi has successfully managed the largest onshore hedge fund and has an exemplary track record of beating the markets across cycles. Last but not least, let us welcome Mr. Anil Ghelani from DSP Investment Managers. He is the head of passive investments and products. He also serves in the board of CFA Society of India as a vice chairman. Without further ado, I open the panel discussion, and I'm extremely confident that each one of you in the audience, including me, are going to have an enriching 60 minutes.
Gentlemen, thank you once again for being
part of this panel. I'm Anindya Banerjee. I'll start off with the first question to Mr. Sanghavi. My first question to you, sir, is that though the stock prices have witnessed a V-shaped uh, recovery, but the underlying economy remains exceptionally weak, how sustainable do you think is going to be the rally in the equity markets? And what are the couple of major risks that we need to be mindful of? Over to you,
Sure.
Mr.
So,
Sanghavi.
sure. So, Anindya, let me kind of say that, that's the very hotly debated question where people are trying to figure out that why the stock prices are close to highs when the economy is in turmoil and where the corporate earnings are not kind of coming about. Now, one of those answers is basically, and only one of those is basically that it's the incremental tremendous liquidity infusion by all the global governments, both on the monetary side and the fiscal side. Just to give you a perspective and a number is basically in the last 6 months, the incremental stimulus, both fiscal and monetary, has been close to about $20 trillion and more. And as we say that, it is even coming more when we see that US is kind of planning to have a further fiscal push. Now, just to again give a perspective that in 2008 and 9, when the crash happened, or the Lehman happened, we had seen at that point in time that quantitative easing, because of the quantitative easing programs, the Fed balance sheet actually increased from about $750 billion to close to about $3.5 trillion up till the last year. Okay, but now within the last 5 months, the same Fed balance sheet has gone up from about $3.5 trillion now close to about $7.58 trillion. So the point in what I'm trying to say is basically that there has been a tremendous liquidity push globally. Liquidity will find its way into assets, and the asset prices are likely to go up, which means that while the earnings or while the economic growth kind of come to its own pace or get stabilized, we'll continue to see the valuations kind of elevated, expanded, and a disbelief among the investors saying that nothing is happening on the economy and the corporate earnings, but we are up. So one of the prime reasons is definitely the liquidity, infusion, apart from the month-on-month recovery, which is happening post the unlocks, which we are seeing. So these are the two kind of prime, movers of the asset prices currently.
That's an interesting point. Thank you, Mr. Sanghavi. Now I will be asking this same question to Mr. Ghelani, but slightly different way. Yes, the liquidity is taking the multiples higher, but if I focus on the economy, it's actually facing a triple balance sheet problem. Government, business, and households, three are having a strained balance sheet. And this was the case even before COVID, and COVID has made things worse. So if I ask you to take a 12 to 18-month kind of horizon, do you think that there will be a significant comeback in the earnings, or would we be hostage to this ebb and flow of liquidity taking the multiples up and down? Over to you, Mr. Ghelani. Can you hear me? Can you hear me? Mr. Ghelani, can you hear me?
I'm not sure.
I think there is some audio issues. So I'll cut to you, Mr. Beri, and then I'll come back to Mr. Ghelani.
Okay.
Yes.
I think the liquidity issue has been mentioned. What I think is more important right now is the fiscal side. At least let me start with the US side. So what is happening is the governments across the world are helping in with the rents, or rather with the mortgages, and every individual has got a check for $1,200 in the US. What that $1,200 does is actually does two things. One, you're not going out, so you're not spending as much, so you have more savings. And secondly, for a lot of people, that $1,200 is actually a lot more than they used to earn when they weren't working. So that has a double whammy effect. basically what happens is that the money flows into the 401ks, and 401ks generally are in the passive side. So money automatically, no matter what happens, the money goes into these passive investments, and the passive managers have no choice but to buy at the end of the day, irrespective of the price. Now we talk about the earnings mismatch. Let's talk about, so what is the stocks that have contributed the most? So if you look at the S&P 500, just the 5% have contributed the most, while the rest are exactly where they were a year ago. So that hasn't changed. So people have been, so where are the earnings coming from? Earnings is going into and driven by the technology companies, and their earnings have actually not gone up, but the expenses have gone down. So what that means is that the margins are much better. Yes, the old style economy and the old style companies have a problem, but not so much in the new type of economies that don't need balance sheet. They are automatically getting richer and fatter. So what is the economy is a big question. The economy, if you think about where the GDP is coming, yeah, they're making money. Where the economy, if you think about employment side, which is the face of the hotel sector, the hard manufacturing sector, the service sector, that's obviously hit. But they used to get less money anyway. But that's being compensated by automatic money that is coming into their account, and that's why everybody is focused on this next stimulus paycheck that the Democrats and the guys are negotiating, and obviously the market is discounting that it will get sorted out. The other thing that is happening is that people, are not allowed to get thrown out of their houses. So a lot of people are not paying. So what that means is that the liquidity issue is being sorted out, but not the solvency. So at some point, you may have this issue with the solvency as well, and that would be the tricky part. When that is, we don't know. But at the moment, automatically people have to put money into the equities. They have no choice. And that's where the money flows is coming. And I think people mistake it as some active buying. Yes, there's some more active buying because the new minted day traders are there. There's the big following in Reddit for the US, the Robin Hoods. In India, I see Zero Hadda, whatever, and other where the leverage is there. So all these guys are not into value buying. By definition, they will be chasing momentum. So whatever is going up today, that's exactly what they will be buying. They will not buy value. They will not buy fixed income. And that is left to the professional investors. If you look at the credit side, everybody is buying high grade because that's where the Fed is buying, or Fed is buying the ETFs in the fixed income side that invest in the high end of the high yield. So those two sectors are supported, but the rest is not. The credit hasn't rallied even, at the low end. The triple Bs or sub triple Bs are lagging, and that is, and you can see that with volatility, what's happening to the volatility. So hopefully that explains a bit.
It's a nice point. So both the perspectives from domestic and international market is that liquidity is the driving force. As long as that stays as the biggest force, it's going to be a story of the multiples. Whether it's 18 times, 25 times, that's going to decide the next 30% up move or the 30% down move. Now, as a follow-up question to you, Mr. Beri, there's an interesting phenomenon I would like to point out is that since 2010, the US stock markets have begun to outperform the emerging market equities. Now, at this same time, dollar also has started to appreciate against the emerging market currencies. These two trends have gone together hand in hand. So it's been like almost 10 years, a decade of outperformance. Now, do you think this kind of a trend will persist, or it's going to reverse, and in like what happened between 2004 and 2010, that the EM started to outperform the US and USD went into a secular decline? So I'd like to have your thoughts on that.
So It's a very simple, actually, and easy one to answer, at least for me. Basically, if it's a liquidity driven market, the money will be invested only in liquid markets. And EM will get the allocation based on that. So that's number one. Number two, driver of it is the earnings differential. So if an emerging market who's now earning less because the factories are closed and they have a much larger service economy and a much manufacturing that is not getting back in its full force, is suffering. So that earning differential is being narrowed. The third and the most important thing is the real yield differential. So India, for example, for many years, I think until 2018, was delivering 4 to 5% real rates of return. Now, if you're delivering 4 to 5% rates of return, why would you not buy India and other countries, including China? And the other one is in the indexation. So China has been getting a lot of money because it got included in a lot of the indices. And people are forced to buy China, irrespective of what their view is. So EM is being driven by these two factors. Now, when you talk about liquidity, how can you tell about liquidity matters? If and when the market sells off, which market goes down first? It is the India and the Korea, and then Hong Kong, because that has the most open systems of capital flows and the highest amount of liquidity. So hopefully that answers it. I don't think it is ready to say. I'm ready to say it's ready to outperform as yet. As long as the paradigm is liquidity and earning differential narrowing, I think it's hard to see EM outperforming.
Okay. So the growth, which has an impact on the earnings differential and the yields, is what is causing this kind of lagged impact of the EMs, and the EMs are kind of being carried by the DMs. And DMs, I mean the US market, not really Europe.
The EM allocation in 401ks is very small. So money is not being allocated to the EMs from 401k, which has been a major source for a lot of this global liquidity.
Right. So I'll now cut to Mr. Ghelani. Can you hear us, Mr. Ghelani?
Yes, I can hear you. I'm really sorry. I just got interrupted in a minute. I just went off.
So this question is to you, is that quite to the dislike of the followers of pharma and French, the momentum as a factor of investing continues to beat value. However, there are two major disadvantages often cited for the momentum investing is it has a high turnover, so high expense ratio. And second thing is the drawdowns are pretty large. So what do you think is the future of momentum investing? Do you think momentum investing will continue to do well in India specifically? And considering the fact that now a lot of money is coming through ETFs, global ETFs, and as well as the passive fund industry in India. So over to you.
India, that's a very good point. I think the debate of momentum versus value has been one of the core fundamental aspects of any kind of investment strategy. So if I may put it the other way around, let's say if you are a person following trend following approach or a trending type of a person, that means you are following either momentum or structurally like if you want to talk in factor terms, either momentum or growth. And if you believe in mean reversion, then you are trying to look at something like a kind of a value type of a strategy. In my view, both have its own time. At certain points of time, one has to see the cycle. In India, currently, if I look at the last about 20 to 24 months, we have seen a huge polarization in the market, especially that is driven by quality as a factor. So there is a rationale to it, why it's happening. That people have been worried due to 2-3 factors. Right now, the factor is the uncertainty relating to the crisis situation we are facing. Before that, there was some other situation. So people have been a little bit worried about the earnings, about the earnings quality, about the growth in the earnings. And because of that, very often the mind tends to shift focus on quality stocks. Let's say whether it's in different sectors, like I don't want to go into sector specific, but typically on a factor level, the alignment has been towards quality, and that has led towards a momentum-driven rally on quality names. So if we see today, the way in which our markets, if you dissect them into parts, large cap and mid and small cap, in the overall market, the mid and small cap leave out the recent time, but if you look at, let's say, last 1 to 2 years period, mid and small cap have been a little bit underperforming. Only large caps have been doing well. And within that, Anindya, what I'm trying to highlight, specific to your point about momentum, is that there is only a small pocket of these large cap names which have been more the kind of active drivers of the broader market. Now, that is nothing but a momentum strategy. Yes, you are right. In some way, very often that does result in extra turnover and hence little bit cost, etc. But structurally, till the time this little bit uncertainty type approach remains, it will continue to chase momentum. But in these times only, then value opportunity opens. In such times only, one can actually look at bottom-up stock by stock selection, look at a way in which some cyclical sectors can move up, and value buys can become a good investing opportunity at this point of time. So, to your specific question, in Indian markets, considering the overall way in which flows have happened, both from global ETFs, domestic passive funds, as well as some anxious approach in terms of I want to keep a quality focus across sectors, whatever I might be looking at. So that has led to this momentum strategy doing well. And I think in India, momentum has been a factor which has done well across time cycles over the period, except for certain inflection points where if you are relying only on momentum as a strategy or as a factor, you can get beaten very badly. At certain inflection points of the market, one has to be very, very careful and make sure you are fast to align your positions. Otherwise, you will get hit very badly. So it's a very important aspect to keep in mind how to realign that. Yes.
So momentum, can it be rephrased as a glorified form of herding behavior? And if that is so, then has the social media and proliferation of that accentuated the herding behavior in the financial markets and the WhatsApps and the Twitters?
Well, Anindya, I feel a little bit that could be a way of thinking, but structurally, no doubt that social media and technology has enhanced the flow of news and information about companies, about stocks. But still, if you cut out all of that and you focus on the earnings of the companies, hardcore number-driven approach, if you take, irrespective of how you get the numbers from a WhatsApp or from a Twitter, or you log into the company's analyst meeting,
Right.
if you are looking at the earnings quality, and if you are a rational thinker and you are concerned about earnings quality of the other three companies of that sector, as a natural thinker, you would want to go with the company that is having a slightly more robust earnings quality. Just I'm trying to highlight it that way. You know, I understand your point where you're coming from. That maybe these last 5 to 7 years, I think, you know, if you slice the entire market into two, like the earlier decade, like 2000 to 2010, and in 2010 to 2020, in this last decade, especially towards the second half of the decade, you have seen a significant change in terms of the way in which you and I share and absorb and analyze information. You know.
Absolutely. Now I'll cut to
earlier. Let's say we just started the quarterly earnings season. Earlier, after a company has a quarterly result, you know, next day morning, typically, you know, 1 or 2 staff brokers would have their report on your desk that, sir or madam, look, this is my latest fresh of the cuff, like analytics. Now today, on that same day by evening, you get at least 5, 7, 10 reports on your mailbox, and you know, the entire approach has changed. But as I said, one has to look through that approach and you know, come to the actual balance sheet or the numbers to really understand the quality factor and the momentum which is a resultant of that at this point of time in the market.
So I'll now cut to Mr. Sanghavi. If you look at the sectoral performance of Indian stocks since March lows, IT, pharma, autos. These are the three sectors which has significantly, significantly outperformed the Nifty. But whereas the bank and the NBFCs, consumer goods, and infra has lagged. So do you think people are actually paying up significantly for stability? Because if I look at the earnings growth of let's say IT company, it has been consistently earning around 10%, but the multiples have gone up significantly over the past 3 to 4 months. Are people actually paying up for stability? That's question number one. And the question number two is, do you think this kind of a mix of outperformance and underperformance will continue, or are you expecting a reshuffling? Over to you, Mr.
Sure,
Sanghavi.
Anindya. Sure, Anindya. So what happens is basically, for us, we divide the period into pre-stabilization and the post-stabilization period. And what do I mean by pre-stabilization here is that we saw that huge turbulence or market volatility because of the COVID. And what do I mean by pre-stabilization is the period where the economies are kind of locked down. There's a massive impact on the economy, the corporate earnings. And post-stabilization period is where you kind of find some point of treatment, or people are kind of okay or are accepting the way to live with this COVID treatment, or are anticipating the vaccine as well. So in this kind of pre-stabilization period, you will always find the fear factor to be pretty high, and in that in that elevated fear factor, you will find the preference towards your defensives, something like a pharma, IT, or consumer staples as well, where the predictability of the earnings is little better than the other sectors. At the same time, when things kind of start getting a little normal, and people think that, hey guys, this is now over, and I think we should be looking in a couple of quarters towards normalization, then you may see the preference of sectors coming towards your consumer discretionary or towards banking and financials as well, right? So we can say that we are roundabout in midst of both of these periods, where we are in transit, where people are now started to accept or they have learned to live with COVID. And also there is an expectation that vaccine would be there probably in a quarter's time,
Right.
and things would be normalized by first quarter of calendar year 21. And that is where I think you will find preference towards recovery sectors such as consumer discretionary, banking and financial, and so on and so forth. So the structure and the movement of the market may keep on changing, but the underlying fact, which again you pointed out, is basically that amidst the volatility, you will find that liquidity will keep on pumping into asset prices, and like what we saw, IT valuations kind of saw a great jump. Of course, the earnings have been supportive, but you will see that other sectors also will start to catch up on their valuation parameters on the higher side. So that is how we are looking at, and the structure of the market may change slightly.
Interesting. So the next set of questions are regarding this whole big debate between active investing, passive investing, and the AIFs. So I'll start off with Mr. Ghelani. Data on the mutual fund performance shows that over the past 3 to 5 years, very few funds have actually or schemes have actually outperformed the Nifty across categories. So if I consider post fees, do you see this as a structural change in the industry? And if so, would this lead to the big shift which has already happened in the West? A significant amount of AUM is going towards ETFs and passive funds. Over to you, Mr. Ghelani.
I feel that we can dissect the overall mutual fund industry into two segments. Like within the active funds, you can look at two segments. One is the segment which invests into large caps as a particular universe, and the other is that invests into mid and small cap, multi caps, thematic, sectoral, that other part. What I feel is that in the first segment, that is the large cap space, that is a space where a large component of this aspect, what you are saying, has been visible, that in large cap space, it has become more difficult to outperform the benchmark. And very interestingly, I will draw upon the point we discussed just some time ago, that in the past few years, the changes in the way in which social media operates or technology has changed. That is one of the key factors for this transition change in the large cap space. The second part is that in general, over the past few years, the research coverage of large cap stocks has significantly gone up. So if you look at today, when you say large cap, you define it as broadly top 100 companies by market cap, right? I mean, that's a generally accepted trend as per the guidelines, etc. Now, within these top 100 stocks, each of the stock has a wide coverage by analysts who are constantly tracking the company. There is increased social media today. If I am just out and going for some, let's say, some shopping or some particular event, and I click a selfie, and at the background, suppose there is a promoter of some company, immediately news will flash out that, oh, such and such companies, so and so was at this place or was into this situation, and people start thinking about what the rationale or trends are going to be. So if again we look at the history and then we try to see what today we are seeing in the market, in the decade of 2000 to 2009, look at the entire large cap space, the average mutual funds had outperformed the Nifty 50, the Nifty TRI, total Indian index, by about 4.5% CAGR. So it was like a reasonable good outperformance, net of fees, everything. So let's say on an average, if you were to select even the average large cap fund, it would have outperformed Nifty over that decade. In the next decade, that is 2010 to 2020, if we see, the average large cap mutual fund has outperformed, but only by a very small margin, 0.1%, 0.10. And this I'm talking about a long period of time, 10 years, and I'm looking at data which is 5-year rolling returns. So it's not on one point of time in that time zone, 5-year daily rolling return. So it's like, comparing like multiple time periods in this bucket of 10 years. So if one were to think of that in this last few years, this type of a issue has been, this type of a situation we are seeing, where in the large space, it is becoming a little bit more difficult to outperform the benchmark. But if you look at mid and small cap, thematic, etc., I feel that still in Indian markets, there is a good scope for generating outperformance and beating the benchmark. Like if you spoke about global trends, absolutely right. I think globally this happened. Let's say specifically to US market, if you look at 1 decade ago, where 2012-13 was a time period where the flows into passive funds outpaced the flows into active funds, exactly like about 8 years back. And fast forwarding to today, like it's almost the reverse. Like last year, I mean, I have not tracked the data of current year 2020, but 2019, 2018, both these years, if you see, the active funds have seen net outflows, whereas the passive funds have seen net inflows.
Right.
So that shifting trend probably will gradually come, but at the present moment, I think it will start with more large cap space.
Right. That's an interesting perspective. So I'll now switch to Mr. Sanghavi, because he has the unique hat of wearing as a AIF fund manager, hedge fund manager. Now, if I take the category 3 AIF, Mr. Sanghavi, how do you see them playing a role in this vanishing age of alpha, which is becoming a difficult thing for even the mutual fund manager? So is the alpha of the category 3 AIFs be largely driven by the leverage which they can take, which MF can't?
Sure. So Anindya, how we would look at is basically in our view, right? We kind of segregate strategies into relative return and versus an absolute return. Okay. Mm-hmm. When we talk about relative return, which is benchmark linked, which again Anil did mention about saying that the alpha is kind of dwindling, we clearly see a path that it's going to be extremely difficult to kind of outperform the underlying benchmarks, right? And that is where we see a very unique role of passives coming into play, and some improvement in passives as well. Not typically kind of benchmarking to that, but some improvement in passives as well there. So on a relative return perspective, passive would have a major role. At the same time, if you want to have something on the hedge fund side, on the relative return side, then it has to be something which can offer you a better risk reward ratio or a risk adjusted return strategy. Okay. If I'm just kind of offering a product which is long only product, which is trying to outperform the Nifty, then there is not much of value add which anybody can do. However, if he is able to decrease the level of risk while being outperforming the Nifty, is when you can say that there is some value being added from a relative return strategy, which can be done pretty much in an alternate investment fund vehicle, purely because you have an ability, as you rightly mentioned, to either take leverage or to do shorting as well pretty efficiently. Okay, so that is one. In terms of absolute return, right, which is agnostic of markets, right, is where you can definitely see an AIF playing a very lead role. Again, offering an AIF actually is a vehicle which can offer strategies from a low risk strategy to a high risk strategy, something equivalent to your debt kind of asset or debt kind of risk return profile to your equity, or even higher risk here as well. So it is just a tool to offer huge amount of strategies, but you need to have that kind of experience to see to that how you can add value to a client's portfolio by, as I said, by focusing on your risk adjusted return strategies. So all in all, what I would say is relative return. You may see passives coming about and different versions of passives, and on an absolute side, you will see AIFs coming about, and that is where I see the scope pretty huge, both on the AIF side and the passive side, and versions of passives as well.
Right. So it's actually the flexibility which comes to the AIF, which actually is not offered to the mutual fund manager because of certain regulatory constraints. There, the AIF fund manager can actually use his or her skills to generate that alpha, or let's say risk-adjusted alpha. So I'll just stick with you, Mr. Sanghavi, to ask you the next question, which is on the ESG investing, because the ESG has become a huge phenomena world over. Just to share one data, the MSCI has the India index as well as MSCI India ESG index. So what I found fascinating was every year since 2008, the ESG index has significantly outperformed the India index except for 2016. And if I compare that performance across various quality of parameters, be it volatility, be it the risk-adjusted return, it has been way ahead. So what's your thoughts on this emerging phenomena of ESG investing?
I mean, I can tell you, Anindya, we are absolutely committed to the strategy of ESG, which is responsible investing as well. The whole thesis when we started looking at ESG was how can we address the tail risk of a business for investing, right? And when we talk about tail risk, you definitely take into account that if you can take all your stakeholders together to grow a company, the company has more potential to be sustainable in a longer period of time. And when I talk about stakeholders, is basically your environment aspects, your social aspects, and your governance aspects. Environment, you are trying to protect the environment or control the damage to the environment. Social is you are taking care of your employees with the practices and the policies which you have, and diversity is something which you are looking for. And on the governance side is what you are trying to look at, protecting the minority shareholders. So what you are essentially doing is basically you are taking all the stakeholders together to kind of see to that you're buying into businesses which are high on ESG rankings, which are taking care of all these three aspects while running their company, which gives us a great chance to avoid the tail risk which may come about into a business, because if you are taking care of these factors is when you can add a sustainable business prospects to that segment. Now we did actually start this strategy about 1.5 years back, and we ourselves also have noticed that our performance also has been kind of outperforming the Nifty handsomely, where the other funds are struggling. We are at the cusp of actually exploding into an ESG phenomenon. Globally, as you rightly mentioned, the money is moving into ESG funds, and more than 40% of global money are actually tracking ESG directly or indirectly in terms of their decision-making approach. And if you look at valuations of, if you see carbon or carbon emission, or if you look at probably tobacco, you can clearly see the valuations of all these sectors which are non-ESG are dwindling, right? Purely because the move or the money is moving into ESG compliant sectors. And that is where we do think that ESG is a fantastic opportunity in the next many years to come. And that is something which an investor should surely look for as a source of generating their alpha into their portfolios.
Right, sir. Before I ask the same question to Mr. Ghelani, a short announcement. Members of the audience can ask or post their questions on the chat box. So you will see a chat box on the application. You can use that to post your questions. So we'll have a Q&A round from the audience at the fag end of the discussion. So coming back to Mr. Ghelani, obviously I'll ask your perspective on the ESG investing, but because you're also in the board of the CFA Institute, because since 2015, I presume CFA Institute has been focusing a lot on this, the different aspects of the ESG investing. So considering that, I would like to have your perspective.
Multiple organizations, whether it's CFA Institute or CMT Institute, I mean CMT Association in many ways, or many other bodies. Over the past, I would say 5-7 years, a lot of effort has been done in terms of enhancing the awareness, enhancing the reporting, and enhancing the tracking of ESG parameters. I'll take it with a classic example. With people right now with us only over here, we have got Refinitiv as one of our, the partners of this this event, and I saw suddenly some chart had popped up right now. So for just taking that as one example, like Refinitiv has a large team sitting world over. They cover some 4,000-5,000 stocks globally, and are constantly coming up with ESG ranking and ESG scores. Let's say 5 years back, maybe I'm not even aware whether they had such a big team or something of that sort. Maybe 5 years back, there was not so much appreciation of ESG in a specific context, though I think in a great manner, as Vaibhav also mentioned, that while analyzing a company as an analyst or as a fund manager, you are definitely factoring in these aspects in your analysis. Like for example, G is a governance as a factor. I mean, it's a no-brainer. It's one of the main pillar for you to analyze any stock. Like today, even if not even fundamentally meeting management and doing a stock by stock pickup, let's say even if quantitatively running a fund, like we have a fund called the quant fund, and we filter out companies based on some quantitative parameters. So even in that, one of the core fundamental aspect is the G part, the governance part, So unless you don't have a comfort on G part, you don't have a comfort on the E part, like the companies being environmentally responsible. Certain elements of the S part, one can find sometimes difficulty to measure actually, or put some number to it or whatever. And that's where help from this kind of data analytics or partners such as Refinitiv come into the picture. That the enhanced awareness and tracking, everything is coming together right now as we speak. So, in my view, the efforts being done by independent bodies like the CFA Institute, like you very rightly said, we have recently, in fact, on a global level, come up with a paper on how the ESG framework should evolve, in India, SEBI has recently come out with a draft guidelines. In fact, just I think week before last, I mean, everybody, it was open for public comments. Everybody, including us as a house, as a DSP, DFA society, as an India body, has submitted responses, which 5 years back nobody was even so much aware of talking about. Fine, it was being done, but now it's coming into detailed, enhanced focus. Now we are very much aware. We are looking at this type of a data, and we are utilizing that not just for investment analysis perspective, but also for putting the company and the company's management on the spot, that you disclose what you are doing for your responsibility and for your own sustainability in future.
Right. So as more funds come into this kind of theme of investing globally, and obviously, so from world to India and within India into this theme. So this wedge between the traditional investment style and the ESG investment style is going to increase, because that's how
I think I will just, you're right, Anindya, but I would like to take slightly different approach. It's not about as new funds come,
right.
New ESG funds come. That is not the point. See, as of today, there are some 3 ESG funds in our industry. Okay, one is by vendors on the AI platform. In mutual fund platforms, there are I think 2 or 3. And there are some fund houses who have filed for fresh ESG funds to be launched right now. We as a DSP also filed. It's a public information, so I don't mind sharing. We have filed with the regulator for launching a new ESG fund. But that is not so much important, because when a new fund comes, let's say it will raise a couple of 100 crores, a couple of million dollars. I'm talking about the entire shift in which investment management is being done, wherein as a part of the investment management framework,
right,
like us or many fund houses have started incorporating ESG scores or ESG parameters as a filtration for picking up their stock universe, or they have started using that as certain measures on the basis of which communication or discussions with the company management takes place. So let's say out of the entire pool of money being managed professionally under mutual funds, AIF, PMS, etc., funds which are labeled as ESG dedicated funds might be small pool of assets. But entire shift is already happening, and through forums like these, like you brought up a very good point, but I'm saying through forums like these, it has to be enhanced more and more.
Right. So the next point from the ESG is now, I'll cut to Mr. Beri, that I would like your thoughts on a very important shift that happened in the macro markets after the Fed changed its stance to something known as average inflation targeting. So is that a game changer for the emerging markets? Because why I am saying this, I'll give a little perspective. Because what Fed is saying, that we want average inflation to stay to be around 2%. If I look at the historical data, 10 years, 15 years, for inflation, especially the core inflation to average above 2%, has not been much. So it means some people are pricing in that means Fed may not hike for years. And at the same time, Fed has out with a second mandate saying that we want broad-based, diverse, diversely strong job market. So the maximum employment, average inflation targeting can only happen if you have a weak dollar, because a weak dollar pushes up the commodity prices, that creates an inflationary pressure, that has a positive impact on the global economy. That is again something which is positive for the US. So has the Fed, Mr. Beri, invariably adopted a weak dollar as an official policy?
No, I don't think so. I think that is not in their remit. It's usually the Treasury who does that. What they're trying to do definitely is they have stated obviously very, very, very strongly in every meeting that they will let the inflation run hot if and when it comes. The problem with the inflation is that it's not just the lifting of the commodity prices. So let's take for example, the price of iron ore in China and lumber in the US. They've both been massively robust. lumber obviously went up and now down again, and very sharply. And see, it created the essence that there's a lot of economic activity and inflation might be coming. Same thing with China. But they have different reasons that are driving it. So, for example, lumber, very simply, you couldn't get the supply. Same thing with copper, there were supply issues. Same thing with iron, there were some supply issues. And then as China plugged in their investment led, which is building of infrastructure, and it was very easy for them because it's a centrally command economy. They said, right, we are going to reinvest in fixed asset investments and let go of the restrictions in property development. So the first thing that happens with that is the iron ore. So the demand for iron ore has shot up, yet it hasn't translated to the rest of the world. So now they have excess supply of and production of steel. So what are they going to do? They're going to bring down the price of steel by dumping this excess supply, because they've already reached that thing. Same thing has happened with copper. And you're also going to have the same thing with food prices. One of the things that happens in India, you've seen that, because of the supply bottlenecks, prices of essential foods will shoot up from time to time until it's brought under control. So there's a time lag to it. There's no question that they don't want. How are they implementing this thing? So the first thing that would have happened with this Fed policy was the curve would have steepened, because people would have said, oh, the curve will steepen, inflation will come back. So the Fed has gone out of the Fed's way in trying to buy two things. One is they've been buying inflation-linked treasury securities to keep that expectations in check. Secondly, they've also been buying bonds up to 5 years and 7 years. So lately, what has been happening, if anybody has noticed, is that the long end yields have been trying to break up. So traders and professional money managers have been putting on these curve steepness trade. And what that means is very simple. Two things will happen. People will automatically also think that the inflation expectations, they're trying to manage it, but it's very, very difficult to manage inflation expectations beyond a certain part of the curve. The best example is probably Japan. Japan is controlling the yield curve at 10 years. But the problem is that the yield curve between 5 and 30s has been going up. If you look at China, the yield curve hasn't gone up, but the long end, the 10 years, has been going up quite independently because of, despite the fact there's so much money flowing. So it's all kind of linked together in a way. The yield curve is much more controlled in Europe because they really do have deflation still. So it's not working. It's not because they're stating the obvious that inflation is not there. Yes, how are you going to have inflation when people aren't able to go out and get a job? People who are working from home are getting the same thing. In fact, salaries are being cut even in technology things. So you're not really going to get inflation right away. But from time to time, you're going to have these supply issues. You're going to have these dislocations that will drive up the inflation expectations in different markets. So for an EM, for example, just to finish it off, it was wrong for India to target inflation for a very long time. Inflation has been on a downtrend in India for long, and I think the central bankers were responsible were using the developed country model and thinking that inflation will creep back into 6-7%. It hasn't. The Indian structure has also changed as it gets closer to the world economy. So it's the right thing for India not to focus on inflation targeting. So I'll stop there.
So the inflation is going to stay low, and that may keep the Fed close to zero for a long period of time. With this, I'll actually switch to the audience Q&A. We have just enough time for one question. In fact, there are a number of questions which have come, and there's a whole host of questions on the ESG framework. People asking about certain stocks, whether like some tobacco companies and etc., which actually means that the ESG as a phenomena is really catching up. So I'll pick one question, and which is on the currency market, which says that with interest rates now almost at zero, is there going to be enormous volatility? Because a major plank of currency valuation is interest rate differential. With not everybody at zero or negative, there is not much to go by. Even the EMs are cutting rates to record lows. Does that mean that other factors would create enormous volatility in the currency market in the coming years? So this question I'll ask to Mr. Beri, and if you can just keep the answer brief, because we have just 1 minute.
Okay. Very briefly, like I had mentioned before, if the first thing that will continue to drive is the chase for relative growth differential. So if long as that is there, then you will see flows into EM and those particular companies that offer that. So India has a huge pool of technology. So from that perspective, yes, definitely. Interest rate differential don't matter. Nominal, but you have to look at the real rate interest rate differential and the market driven one, and that I think is still a major driver. So those two for me are the top, and that's really it. And then the flows, the third one.
Right, sir. So with this, I'll conclude the panel discussion. I thank all the panelists and everybody in the audience, and also urge you to just take a little break before the next session starts. Thank you once again.
Anindya, I'd like to make one quick point for the benefit of the audience. Firstly, gentlemen, thank you so very much for a session that's been so enriching to all of us. And for the audience members, what we will try to do is we have a lot of very good questions that have come in. We will collate these questions, and the responses to these questions, we'll work with the fine gentlemen on the panel, and we'll come back to you as an article in Technical Insights, the CMT India newsletter. Opportunistic plug, I call that. But thank you very much.
We very much look forward to going through the questions and giving some responses and views on that. Definitely, Joel, we'll work together on that.
Wonderful. Thank you so much.
Thanks.
Once again,
thank you.
Ladies and gentlemen of the audience, please take a quick break, and we'll see you in the next room at 3 p.m. sharp, India time.
Okay, thank you.
Do we click off?